Welcome to the weekly update. This is Being Prepared Friday, April 15th on Good Friday. And we'll talk about the action in the market for the week of April 11th through the 14th. And then we'll see how things look for the week ahead, which is April 18th through the 22nd. And this past week was pretty negative. And even though it was shortened by one day due to the holiday, we saw really kind of a negative vibe going all week. There was one day where we tried to make a comeback, and I'll show an intraday chart here in just a moment, but we really were pretty negative overall. On the daily charts, we're pretty much negative across the board. There's one area that has not really become very extreme negative, and that is sentiment. We like to see a lot of fear in the market. And when people are all freaking out and getting all worried about things, that's when we're usually looking for some kind of a bottom. Well, right now, we've got a lot more room to fall before we establish something like that. Now, we could go up from here. This could be a very positive week, but right now on the daily charts, everything is looking pretty negative. So now I'm going to go through some of the weekly charts and talk about the week session that we just finished. So for the week, we saw real weakness pretty much on Monday and Tuesday. We had gaps lower. One day we gapped higher only to give all that up and then end lower. We tried to make some kind of a rebound on Wednesday after we became oversold on a very short-term basis, but we gave all that back on Thursday. So it really, the one real attempt at trying to take things more positive, that just didn't happen. We ended up being down 2.1% for the week, and volume was below average, which we didn't have Friday to calculate into this. So, but on a daily basis, we've been seeing below average volume. Even when volume goes up a little bit, it's still below average. So it's pretty safe to say that volume has really tapered off. The technicals right now are leaning a lot more negative. There are some positive things that we can look at, and I'll try to point those out as we go through this. But the real fixation right now is inflation and interest rates. That's the scenario that the market is currently running with. We have a lot of geopolitical concerns, Russia, Ukraine, China with the supply chain issues, just the overall feeling going around these days, both within the US and then around the world. There's a real negativity right now, but for the stock market, what it's choosing to really focus on are interest rates. And I'll bring up some charts that really show the relationship, especially between tech stocks and how interest rates are behaving. Our trend right now is negative on the weekly charts, and it is also weakening. So I'll have a chart of that as well. So interest rates dominated any stock price movement. The one day that we could have gone up was Wednesday, when interest rates actually declined, but stocks still went down anyway. But typically, so it's not really working in the favor of stocks if interest rates go down, but it's sure working to their disadvantage. If interest rates go up, tech stocks are just getting hammered, and those are growth stocks, and those are the stocks that bring out a lot of upward movement in the S&P 500, especially in the Nasdaq and the Nasdaq 100. If those stocks are not showing any strength, or if they're actually going down, we see that come through to those indexes, and that carries over into the S&P 500 as well. And one thing that did happen this past week is all the different yield curves that we look at are no longer inverted. They're acting more normal now. And I'll address that a little more later on. The big the big economic reports that came out over the past week are the Consumer Price Index, the CPI, and I have a chart of that. I don't have a chart of the PPI, but it's the highest recording they've ever had since they've been recording the PPI. And it was up over 11%. And those are the prices that producers have to pay to make the things. And then the CPI is the Consumer Price Index. Those are the prices that we have to pay when we go and buy these things. So we're seeing a lot of inflation coming through in the economic reports. Then on Thursday, we had consumer sentiment come out, the initial or preliminary reading. And it did show that people are a little bit happier, but they're not necessarily happier right now. They're happier, they're seeing more hope into the future right now. And then, as I stated before, fear is not really extreme right now. So here's an intraday chart. And I tried to add some things on these charts. Here's Monday's session. We're kind of, because we had the 4-day trading week, it's looking a little bit different. But on Monday, we gapped down and then kind of trailed sideways and then fell off right at the end. That's pretty negative because it's the professionals who close the market. And when you see a lot of selling going into the close, that's pretty negative. However, on Tuesday, we gapped higher. This was probably the most disappointing day here. We tried to go up, bounced around a little bit, and then everything just tanked for the rest of the day. We closed a little bit up off of the lows, but to see an attempted bounce and then give all of that up, that was pretty negative. We tried another attempt on Wednesday, and this was a pretty solid day right here. This looked pretty good. There's only one problem. Thursday, we gave pretty much all of that back. So it's, and this is what you see in more of a sideways choppy market. We're not really seeing that yet on the weekly chart with the ADX, but on the daily chart, we have dropped below 20 and the ADX is declining, which is pretty indicative of this kind of action that we're seeing. Not a lot of trending, choppiness. One day we're up, the next day we're down. When everything's said and done, we really haven't gone anywhere. Okay, so for the week, it was actually the small caps. They performed the best, which could be a little bit positive. I'm going to keep an eye on that because back in the middle of March, before we saw the big bounce that took us through the end of March, the small caps recovered just a little bit ahead of time. And sometimes that is a signal or it feeds into the bigger stocks and the S&P that ends up going higher as well. So we're not really seeing that, or I'm not seeing that yet on those charts, but I'll keep an eye on that. To have the small caps do better than any of the other indexes is a pretty positive thing. Then we had the mid caps, the Dow, it's been chopping around, doesn't really go up or down much on a percentage basis. And then the S&P was down, Nasdaq and Nasdaq 100. So the tech stocks really got hit the hardest this past week. And where I usually get the screenshot from, because there was no Friday session and it's an auto-generated graphic, it's all screwed up. So I just put the numbers on here. And this is just based on Friday to Thursday, where back here, these are all Monday through Thursday. So that's why the numbers are a little bit different. The Dow is down 0.8%, the S&P down 2.1, NASDAQ 2.6 with the Russell. That's the small caps. They were actually up 0.5%, according to the Russell 2000. So our sectors, and because we had a down week, I've sorted them from weakest on the top to strongest on the bottom. The tech sector got hit the hardest. It was down over 5%. Communication, healthcare, which has been, but it was still down on the week. And let's see, then some of the stronger sectors, we had staples were up a little bit, a little over 0.5%. Materials, but then energy, that's been the real shining sector pretty much for all of 2022, and it continues to do that. Then this is just showing how things are looking back here, where energy is performing the best since last Monday. And then we had discretionary, which is down overall, but had a decent week. Materials, industrials, staples. And then way over on this side, financials got hit pretty hard. Tech got hit hard. Communication. And some of these we're seeing on a longer term basis. If you watch any of the daily videos, where I go back to the all-time high set in early January, and I say, okay, how have these sectors performed since hitting that all-time high? And a lot of these will look this chart will look very similar. So now current market valuation, because of the holiday, they usually update over the weekend. I wanted to get this recorded and posted as soon as possible. So I'm recording this earlier than usual. So some of this information is a little bit old. If this is of interest to you, you can go to right back here, currentmarketvaluation.com, a freely accessible website. They have these charts right at the front. What I like is there are 6 different areas that are analyzed, and this is a real chart behind what you see. This isn't just some phony little graphic. These are actually updated charts. But this is a longer term look at things. So the fact that I'm about a week behind with some of the data here, I'll update this on the daily videos as soon as these charts update. And so I come back and watch one of those other videos, probably Monday or Tuesday when I record that. But the yield curve, that's giving us a fairly valued reading right now. But be aware of this, because this model uses the 10 to the 3 month. And that never went inverted. In fact, that one's been going up. It's the 10 to the 2 and the 10 to the 5. Other yield curves that we have, those are the ones that went inverted. So it's coming up with a fairly valued reading right now. Stocks, when you compare them to the GDP, this is called a Buffett indicator. It's overvalued, and you can see we're coming off of an extreme reading, and we're back down into more of this yellow area. The PE ratio is still very high, but not as high as it was. Interest rates are considered to be fairly valued. That's because they're so stinking low and have been for a long time, but they're going higher. The margin debt report hasn't been updated since the end of February. The one I pay attention to the most is this mean reversion. What is the mean price, not the average price, but the mean price for the S&P? And then how far are we away from that mean price right now? We were getting very far away, and then we've been able to fall back, and we're getting from extremely overvalued. Now we're back into overvalued conditions, and I have to cough. Incidentally, I'm hoping that this is the last kind of lower tech video that I'm going to record. I should have access to my other equipment, which has a better sound, better microphone, better video, better software. I can edit out my coughs and hacks and really big screw ups that I can't really do right now. So come back to see if you, that'd be really bad if somebody's went, what, you changed? Well, I don't even notice a difference. So, okay. Anyway, we had a report come out on Thursday with consumer sentiment. This is how are people feeling about things. When this blue line is going up overall, people are feeling pretty good. When the blue line's going down, people are feeling pretty bad. Well, typically in a good, healthy environment, if people are feeling better, it's okay if interest rates are going up as well. Well, what we've been seeing lately is interest rates have been going up, but people have been feeling worse. And we had a pretty extreme negative reading in the last report. Well, it bounced up a little bit. So people are feeling a little better. But as I said at the beginning, it's not how they're feeling right now. It's they're looking more into the future, thinking that things will get better. Okay, then another report that came out is the American Association of Individual Investors. And these are the folks that tend to react to what the market does instead of seeing things before they happen. They go, oh my gosh, everything's down, I better sell tomorrow. And then they sell when we're going up, and they're buying when they should be selling and selling when they should be buying, blah, 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 blah. And that's why I do these videos every day. And that's why even if you're a longer term investor, if you've got the time and if you want to really invest some time in having a good feel for what's going on in the markets, please try to watch these videos every day. That's where they're going to do you the most benefit. But we're showing an extreme negative reading right now. When we drop down below this red line, that means that individual investors are pretty pessimistic. We saw that before the big bounce that came back in March. Individual investors were very negative, and then we went up and they started feeling a little better. Well, now they've become really negative again. This is the only sentiment reading that I see right now that's showing any kind of extreme fear. The other ones are just not showing that. Here's another one. This is the Rydex bearish to bullish mutual fund ratio. When this really spikes up, that means that investors are getting into the bearish funds. And we saw this spike up back in the middle of March. And then everything started going up. So then this came back down. We saw a little bit of an increase, but not very much. So we're showing extreme fear with this chart for the AAII, but we're not showing extreme fear for the Rydex ratio. Then we also have the VIX. This is the fear gauge. It tried to go below 20, and that's kind of the upper static threshold for above 20 means we're showing excessive fear. Well, we dropped back down below 20 only to go right back up above it. And then here is a weekly bar, which is just showing how we tried to come back down and then we went back up. But it's not excessive. If we were at some kind of a significant bottom, we would want to see the VIX higher like it was before when we hit other bottoms up here. And we're just not seeing that yet. Then another thing that we watch is this thing called the Ulcer Index. As the market goes down, people are freaking out because most people only benefit if prices go up. If prices are going down, this has a tendency to rise. Well, on the daily chart, we're seeing this rise, but here we've actually seen it roll over and it's a little bit flat for the past week. And then this is another chart that the Fed puts out, and it's called the Chicago Fed National Financial Conditions. And I just love their long names for everything. Basically, and I try to explain this quickly every time, when we are above this black line, that means pretty bad things. That means the conditions of the economy are just not very good. Well, when we're below this black line, that usually means things are pretty good. And if you look at this, we had a bit of a spike up. This is the COVID plunge. Then here's the financial crisis back in 2008. We didn't really bump up during the dot-com boom and bust, but back into the 80s, and we were all freaked out in the 70s. And then look at where we're at right now. Yes, it is climbing, but we're still well below this black line. So this is not suggesting that the economy is going to fall apart anytime soon. Now, with inverted yield curves, and you do have some weakening in the economy, that might suggest that we're headed towards a recession. But right now, and the folks that do these things, that trade the things behind this, these are some very knowledgeable people. These are people that really understand what's going on. And if they're not freaking out, should we be freaking out? Now, this could change pretty quick. Look how much it spiked up during the COVID plunge. Look how fast it went up during the financial crisis. So yeah, this could change at any time, but we can only look at this for what it says right now. We can't really, we can speculate all we want, but then we're gambling. We want to use hardcore facts to establish our stance on things, and we can only look at the information that we have. And then another one is the spread between really risky loans and not very risky loans. When this spikes up like it did in 2020 during the whole financial meltdown, this means that the riskier loans, people are having trouble paying those back. And so we see this during difficult economic times. Where are we at right now? We're not spiking up, at least yet. Now this could go up pretty fast, but right now it's not really giving us some warning signs. Then another thing to watch is this is the weekly survey of active money managers, people that manage mutual funds that actively buy and sell and try to find good stocks. And when the sectors are performing better, they'll, like right now, they'll jump into energy stocks. And then when energy finally fizzles out, they'll go into another sector that's performing better. Or when they see a lot of risk, they'll get out of the stock market and get more into the bond market and get into less risky investments. So as this is going up, that means they're taking on more risk here. And so that started to spike up. This was in the in the middle of March. And then as we were bouncing up, they were taking advantage of that. Well, this past week, things have been kind of rough. The past couple of weeks have. And we've seen a decline in this, but we're not getting to an extreme reading, at least yet. If we get down in here into the 50 or below area, that's where we really start to notice this. And if we get up around 100, that's where we really take notice of this too. But so we're kind of in the middle, even though we did decline the past week. Now, here's the big inflation one. And I go through this every time. The bottom chart here, the one that's orange, red and yellow together, that's the number that was released this past week with the CPI. This is the inflation rate. And this is what everybody's talking about and everybody's all freaked out about. Well, there's a website called shadowstats.com, and they do things a little bit different. They not only work with the number that we were given, but they go back to how was this thing calculated back in 1990? That's the blue line here. And if we calculate the things the same way that they did in 1990, we would be up over 11% interest right now, as far as an interest rate, or I'm sorry, as far as inflation, inflation. Now, this is the one that freaks a lot of people out. If we go back to 1980 and how they calculated it back then, here's the red line. This is what they told us. Here's the blue one. And look, we're at 16, 17%. Maybe even, probably can't make a case for 18, but still very, very high. This is higher than inflation was back in the 70s. I grew up in the 70s. I went through that. I saw these things. But you see back here, this is 1981. We were at 15 back then. We're above that now. If they were to calculate things the same way, and one little trick that is played is if you're on Social Security, how much you get is based on the CPI. And if that number doesn't go up as much, you don't get a cost of living adjustment as much. And so it's like, okay, and it doesn't look as bad. So yeah, would you rather have 8.5% inflation or 17% inflation? But just know that, and you're probably feeling this in your life when you put gas in your car, when you're buying food, and you're hearing about it in the news all over the place. Inflation is just off the charts, and we're getting back to 70s stuff. The one problem that we need to watch out for is in the 70s, we had ultra high inflation, but we also had no economic growth. Right now, the economy is still growing. But if we get into the place where we have high inflation, and the GDP starts going down, that's stagflation. And that could really be damaging. Okay, as far as the Fed watch, where are we at right now? At the next meeting, May 4th, there is a 91% chance that they are going to raise rates so that after that meeting, the rates will be 0.75% to a full percent. That's 50 basis points from where we are right now. When they met in March, they raised it to 25. Now they're going to raise it another 50, which gets us to 75 to 100. There's a quarter point range in this. But this changes all the time, but this is pretty much locked in, at least right now, that we are going to see a 50 basis point move at the May 4th meeting. And then here's just, if you want to pause this and look at it, go for it. To me, it just looks like psychedelic spaghetti, but this just shows you how these rates have changed to kind of get some historical context. And then the Fed's still adding to their balance sheet. Yeah, they're raising interest rates, but still doing quantitative easing at the same time. And pretty much the thought now is that they're going to stop with the quantitative easing and they're going to start with the quantitative tapering, or you could call it a tantrum, quantitative tantrum. They're going to start selling these things. So this line after May's meeting, this should start coming down the way it was coming down back in 2018. That's quantitative tapering. Or you could say quantitative tightening. We're getting more of a tight money policy. But now the question is the Fed behind the curve? Should they have raised interest rates before they did? Should they raise them even more now? Should they have stopped quantitative easing before they did? You know, that's the debate. And only hindsight will tell us what should have happened, because you know, yeah, you can make all your claims against the Fed and that they shouldn't exist and blah, 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 blah. Well, they do exist and they do impact the stock market. And there's so much going on. It's so complicated, the economy, and it's on such a global scale now that you can't put it into a little box. You can't just make it all black and white with everything. They're going, and then you've got people that make these decisions that they come from different perspectives, different education, different experience. Some of them have some political pressure placed on them. They're not supposed to, but they still do. And some of them, they're like, I don't care what, no political pressure here. I'm going to do what I think's right. But it's really hard to try to, land a 747 on a soccer field. That's kind of what they're trying to do. And it's just really, really hard to do. All right, let's go into the charts. Breadth on the week did see a decline overall, but we're still above the moving average. We're seeing more of a decline based on volume, and we're starting to drop below the moving average. The advanced decline ratio also declined. New highs, new lows saw a decline. Can you see kind of a negative pattern coming out here? We're dropping below the moving average on the accumulation, which is buying, compared to distribution. As far as our trend, the ADX is falling, but the red line's on top. That means the negative trend is the default trend. We saw selling increase and buying decrease over the past week. Now, on the daily chart, we've already dropped below 20. So until something happens that can break us out of this trendless environment, you're probably going to see the ADX on the weekly chart continue to decline. The Arun is showing, yeah, there was a decrease in selling, but there was also a decrease in buying. The oscillator is below zero, and we've been flat for the last few weeks. This is another one, the mass index. We're just waiting to see what will happen. We've had the first part of this signal triggered when it goes above 27. Now we're going to see if it drops down to 26.5. Is anything going to happen? That can generate a signal at that point. We don't know the direction. We just know something might happen. Okay, so let's look at our pivot points. We're right on the pivot point. We're actually just a little bit below it, but we could say that we're right on the pivot point. And that means a very indecisive market. Above the pivot is positive, below the pivot is negative. So we're really seeing the markets have a difficult time deciding what way does it want to go. Then looking at our trend here, we are below the moving average. We closed at 43.92. The moving average is at 44.49. So we're below the moving average. That is more negative in our longer term trend. Here we can also see, and this also just shows a lot of indecisiveness. It's not quite a death cross here, and price is kind of all jumbled in with that. So we're really seeing things all kind of come together. There's really no conviction either way right now. BPI saw a little bit of a decrease where we were extreme positive when we had that nice little run up. Well, we've been working off of that, and the BPI has been declining. That's bullish percent indexes of stocks that make up the S&P 500. Here's the Chaikin oscillator. It was bouncing up after being extreme, but has now started to roll over. Chaikin money flow continues to decline. Force index, it's positive, but is weakening. It could drop below zero and turn red. The McClellan oscillator is below zero and declining. The summation index is also turned down, but it's still above zero. So there's kind of, the direction is what I pay most attention to. And then it's just confirmed whether we go above or below zero. So right now, I would say this is more negative, but You could also say it's somewhat positive because we're still above zero. This top calculation is based on price. The bottom calculation is based on volume. Here's our oscillators. They were trying, few of them were trying to bounce up a little bit. Well, they're kind of not really doing so well now. And again, I'm not a big believer in using oscillators on longer term charts because we've been seeing a real negative divergence. And if you had followed that, you would have missed this whole run up for pretty much all of 2021. And the doom and gloomer folks that I listen to sometimes, they were pointing this out all along the way, saying, we're going to crash, we're going to crash, we're going to crash. And the market just kept going up and up and up. Well, some of that has to do with how these things are calculated, because as we go up, they're calculating higher and higher numbers. So these things can't help but roll over. So that's where I come out on it. Now, if you disagree with that, please talk to me about it. Let's discuss this. But this is where I've come out after doing a lot of research and watching this for decades. Okay, then I don't really pay attention to the PMO. That's one of the oscillators that we have back over here. What I look at on this chart is based on price. We are still positive, but we declined. And we also declined, but we're still positive based on volume. Then here's a study inside the PMO. This just shows those that are rising, decreased. Those that are giving buy signals, decreased. Those that are even above zero, they have also decreased. Our RSI dropped below 50 and is declining. The special K, this has been holding up, but this is a longer term oscillator that can be used to really look at longer pattern. I mean, look how long this thing was positive above the moving average. We're talking years here. So it takes a lot for this thing to roll over. Well, we're coming down slightly to flat, but we're still above this moving average. Then we have it's called the short-term oscillator. This is falling below zero and declining. That's negative. This actually bounced up a little bit in the past week, but it's still below zero. So that, half full, half empty. The Williams percent R, after trying to bounce up, has now dropped back down below 50. Our stochastic RSI, same thing, tried to go above 0.5. That's like the 50 on the other chart, and has turned back down. The vortex showing an increase in selling, a decrease in buying. Whoa, what happened here? Okay. And then this is called the ultimate oscillator. It's above 50, so that's positive, but declining. Here's a thing called the money flow index, also above 50, but declining. Here's a thing called the percent B. This is when we get outside of these Bollinger Bands, that's usually an extreme reading. Well, we got right back up to the middle, and now we've been declining. Our different charts, a Heiken Ashi, solid dark bar for the week, that's negative. Kegi, solid black, negative. No, I'm sorry, that's still positive. Red, I'm used to red being bad. No, black, so that's still positive. And our Renko is still positive with the clear box. And our equi-volume is just showing for the last couple of weeks, we have seen down weeks overall. And I have to keep trying to make this bigger, but really, you'll see some new zeros drawn in right here. This is what they call a pole. And the fact that we were shooting up like this, and now we've gone back down, that's a high pole warning. And it was generated on the 11th, okay, right at the beginning of the week. And we're seeing the same, even though this is a weekly chart, we're seeing the same signal on the daily chart right now. The 3-line break is still positive, even though this could redraw and look more negative, but right now it's still positive. Our different trading systems, the Elder Impulse system has switched to red. That's negative, but we're still above the 65-period moving average. And we are declining with the 65-period MACD. Here's the SAR. This is still positive. The dots are below. Broad market. Okay, here's the S&P kind of doing its thing. The mid caps have been really more sideways. Small caps pretty much sideways. We'll have to see. And this is more pronounced on the daily charts, where I talk about how the small caps broke out a little bit to the upside before the S&P did. You really won't see that on a weekly chart. All stocks, these are world stocks, including US stocks. We declined almost 2% for the week. Here's the mid caps, and you're going to see a lot of this. We're seeing death crosses and then prices just kind of jumbled up around the moving averages. See, we're a little bit below when it comes to the small caps, but a recent death cross, it's like we're in the jaws of it right here with the Dow. And then this is the thing called Dow theory, where the very top, this is the Dow Jones Industrial Average. The middle one is the transports, and that's what's giving us a concern. Yeah, we've had a little bit of trouble with the Dow, but look at how the trannies just got taken out, shot over the last couple of weeks. That's because you see rising oil prices, you see supply chain issues, you're seeing a lot of real problems in the transportation sector, and there have been a lot of downgrades from major brokerage outfits that have really kind of clamped down on the transportation stocks. And so we've seen a lot of weakness. Where we use this is if the Dow's setting a high, we want to see the trannies setting a high around that same time, or vice versa. If the trannies are going up, we want to see the Dow go up. That shows a good, healthy environment. Now, some people, including myself, I also put the utilities into this, and utilities have just been screaming for the first part of the year so far. But what I wanted to point out here is just the real weakness. Now, we bounced a little bit on Thursday, but still, trannies have just really had some trouble lately. Here's the Nasdaq. It's showing a little bit more weakness. It's actually dropped below the blue moving average. Here's the Nasdaq 100, same thing. Recent death cross below the blue moving average. That's a 13-period moving average. Here's the NYSE. Also, kind of like the Dow, we're kind of still in the jaws here after having a death cross. And Wilshire, broader measure, it's actually showing some weakness here. It's dropped a little bit below. And then the FANG stocks, these are the big boys, the Facebook, the Amazon, the Netflix, the Google or Alphabet. They were down 4.81% on the week. Here's ARK. That's the Kathy Wood ETF that she manages. She was down 2.75% for the week. Here's the big software companies. They also declined 1.25% and are in an overall downtrend with a downward moving 50-period moving average. Now, this is another thing I want to point out. Sometimes, and it's really hard to see this in real time, and I talk about this on the daily videos. When we see this, the top here is the S&P. The bottom is the staples sector. The things that you have to have, toilet paper, toothpaste, milk, the things that people cannot do without. Where as opposed to discretionary, these are the things that make life worth living for some people. That the second car, the vacation home, the RV, the things that you would like to have, but you could still live without them. Well, the staples, you have to have them. A lot of times, and this is a daily chart, so that's a little bit different than the other charts that I show, where whenever we see a spike in the staples, a lot of times that corresponds to a low in the S&P. And I just went back a few years on this. Well, we spiked right here when we had that low in the middle of March, and then we had a nice run up. And the reason I have a question mark here is, have we spiked? We don't know. This could still go higher. And that's what makes this one a little tricky, because we don't really know if it's a spike at the time, because it could still go higher. So we want to keep an eye on this and watch the staples sector. And if they start showing some weakness, that means that we might, but not just 1 or 2 days. We need to see this over a period of time and then see, is that being confirmed with some of our other indicators? That's what gave us a real good indication that we shot up in the middle of March going to the latter part of March. This was one of the factors that fed into that. So we want to keep an eye on this right now. Okay, the broad market, the CRB, this is what I use to measure inflation, and it's screaming up. It was up over 4.6% on the week. Here's gold, also up 1.42%, still kind of teasing whether it's giving some kind of breakout or not. Here's silver, also up 3.59%, also trying to tease us to see if it's breaking out. Oil got back up to the 106, almost the 107 level. Here's the dollar. It's been hanging in there. And what I've been mentioning in the daily videos is this might explain some of the weakness in the stock market, because the market likes a weaker dollar. It just makes their accounting look better. It makes the import-export work more to US companies' favor. Well, with the dollar really going up, that could be hurting stocks. And we were able to close above 100 on a weekly basis for the first time since the whole COVID plunge. Then looking at some relative markets, bonds against stocks. If you got into bonds, you have really underperformed the stock market. Even though the stock market has run into some trouble, the bond market has been in a lot of trouble for a long time on a comparative basis. Here, this is a monthly chart. This just shows how stocks have truly outperformed bonds. And this goes all the way back to, well, here's the 1987 stock market crash right in here. So there's a lot of history showing in this chart. Then this just goes back 1 year just to see how have different things performed. Oil, in the last year, up 45%. Gold, up about 8%. The dollar's been hanging in there. The S&P is actually down over the last year. And this just goes back to January. So I kind of misrepresented it when I said that it was a year. This goes back to the beginning of the year, where bonds have really underperformed based on price. As price goes down, interest rates go up. And that's what we're seeing happening. Then looking at gold versus the dollar. Well, gold's been going up and the dollar's been going up. So this thing really hasn't done very much lately. Gold against the S&P. It's teasing us here. We saw what could have been a breakout, only to have gold come back down. And then now it looks like it might be breaking out again. So gold might be starting to outperform the stock market. Then looking at what are called low volatile stocks or low volatility. These are the stocks that tend to behave a little better. They generally don't go down as much as the growth stocks do. And this is more of a defensive nature. So if you're only long in your portfolio, you jump into these low volatility stocks when you sense that there's a problem. And lately, well, pretty much for all of 2022, the low volatility stocks have outperformed the rest of the S&P, or in this case, the SPY, which is the ETF of the S&P 500. Then looking at growth against value, it just shows that growth has really underperformed. Here's another showing how the Nasdaq 100 is declining when compared to the S&P 500. This is the S&P 100, the biggest stocks that make up the S&P. It's been underperforming the rest of the S&P 500. And then here's discretionary, again, the things that you have to have, don't have to have, compared to the things you do have to have, and discretionary has just been really underperforming. Here's energy against tech. These are the two big areas that we're seeing right now. And this is just showing how since the beginning of the year, energy has just massively outperformed the tech sector. Then this is the yield curve chart. This is a daily chart on top. And if you want to pause this, please feel free. If you only watch the weekly videos and you want me to email you this so you can look at it and stare at it a little bit, these are all the different yield curves that we have here. And you notice how some of these went inverted, but some of them are climbing. You know, we've got a couple down here that are actually going up. So we're seeing a real contradiction across the board. Well, as of Thursday's close, every one of these has gone back above the red line. So none of these curves are no longer inverted. What we take notice of is after, and not necessarily right away, but many times after we see more of an across the board inversion, and then we go back above, but notice how it chops up and down. Just because we're we went back normal here doesn't mean we're not going to go back down. But look at when we started to finally go back up, this just produced some massive power in the S&P 500. See, inverted. And if you go up here, it was kind of the very tip top. Now, these runs generally don't last for very long, but this is where you can get some really good returns in a short period of time. Here, coming up, this is coming up into the 2008 before we saw the meltdown. Then we saw this right before the COVID plunge, and look and see how we've done since then. Well, now we're wondering, is it going to happen this time? The one concern is not all of these yield curves have gone inverted. That's caveat number one. Number two, there's no guarantee that this will happen this time. We're in a high inflationary environment right now that most money managers, most investors, and most professionals out there, they've never seen this. They're not old enough to have gone through the 60s and 70s when things were really, really, really bad. It was just something they read about in history books. Well, now we're into inflation that many people have just never dealt with before. And what's that going to do to the investing psyche of things? So that makes it a little bit different. Not that there's anything new under the sun, but just there's a lot of new people under the sun that weren't under the sun when these weird things happened before. Okay, so what's our outlook for the upcoming week? And I should have changed, this should have been from the 18th through the 22nd. And I doubled and triple checked this, and it's okay. Anyway, on Tuesday, there's really not a lot of reports coming out this week. We have housing starts, building permits on Tuesday. We have existing home sales on Wednesday. There are other reports during the week, but these are kind of the biggies, and these are pretty much real estate centric. And then we have our geopolitical events, Russia, Ukraine. Yeah, it's terrible. It's awful. And it's really sad what we're hearing coming out of there, but we pay attention to this for how is that going to impact the stock market? And there really isn't anything new coming out of that. In China, with the lockdowns that they've been having, some of those are being lessened, but what's that going to do to the Chinese economy, and what's that going to do to the US economy as well, with the supply chain issues that we've already been having because we buy so much from China? So that's just something to keep in the back of your mind. So what are our scenarios here? To keep going down the way we've been going down, if we see rising interest rates and an increase in inflation fears, prices are still going to head lower, probably. And our technicals are pretty much negative now. With our moving averages, most of our oscillators are looking a lot more negative. Okay, what could make the market go up from here? This is scenario number two. We do have that positive backdrop after the yield curves re-invert. That's what I was talking about with the real yield curve chart. That could happen. Also, on a very short-term basis, and I know this is a weekly chart, but we may see some kind of a bounce early next week because we've gone back to being oversold in the short term, where some of the moving averages and different pivot points may provide either support or resistance. On a daily basis, we are in scenario number three. On a weekly basis, we're kind of fitting more scenario number one right now, where with scenario number three, if we see that ADX continue to decline, then we're probably going to see a real slowdown in price movement and more choppy, a little bit up, a little bit down. That's already happening on a daily basis. Is that going to come over into the weekly? That's what we're waiting to see. Then here's a list of the different videos. Please feel free to check out. I know that my videos can get kind of long, and I don't apologize for that. It weeds out a lot of the people that are just looking for short answers. I want people that really want to study this stuff. But I do a daily snapshot video because I'm also a realist. I realize you don't have 30, 35, 45, 50 minutes to watch a video every single day. And I try to keep this between 10 and 15 minutes. I'd like to keep it under 10, but I just can't seem to do that right now. But watch that. And then if you go, wait, yeah, this is kind of interesting, then go in and maybe watch the full length video where I look at all kinds of charts. Then this is the weekly video that we're looking at right now. Currently, I don't have any of the monthly videos up, and that will happen probably at the end of April. Okay, so thank you. This is Good Friday as I record this. I wish everybody a happy weekend and a happy Easter, and I will prepare the next weekly video next weekend and the next daily video after Monday's session.